So we're talking with Nick Pronsky of Fairway Mortgage today and trying to determine why would somebody want to buy now if we think that interest rates are going to go down at some point in the next year. Nick has put together some numbers. Nick, show us what you're talking about.
All right, let's explore the math. So, what I did here is I put together a kind of hypothetical scenario based on what a lot of people are predicting. So, what if rates go down 2%? So, from the mid sevens to the mid fives, but in that same time, home prices go up by 10%. Because if rates fall, demand goes up and home prices will follow.
And
So, what
we do think that's realistic because there's so many people on the sidelines right now. When rates go down, we think we're going to be in multiple offers again.
Absolutely. The ex CEO of the Mortgage Bankers Association said we are sitting on the doorstep of the largest pent up demand in the history of the housing market.
Okay, so what happens?
So what we're gonna do for this example, we're gonna talk about buying a $500,000 house in Central Texas. So if you're gonna buy a $500,000 house today with 20% down, with a 30-year fixed rate at 7.5, your monthly payment, including taxes and insurance, is about $37.80 per month. So the exercise we're talking about here is what happens if someone waits to buy, whether it be a year, 2 years, 3 years, doesn't matter. But what if rates go down 2%? And then they buy, but the home prices are now 10% higher.
Okay.
So that's what this $550,000 example is. So now your down payment is an extra $10,000 to do
More
the
out of pocket
20%.
up front there.
Exactly. But now the rate's 5.5, so your payment's 35.65. So you are saving money monthly by waiting.
Yeah, but not much.
Correct. At the end of the day, what you're forgetting is that the person who bought today also gets to take advantage of that 5.5% rate. And so they get to refinance at a lower loan amount to the exact same rate. And that payment's $32.93 per month. So if you're just comparing the decision of buying now versus waiting to buy when rates drop, yes, you will save, in this scenario, $215 a month.
But what's it going to cost you?
$50,000 in equity and an extra $10,000 on your down payment.
Okay, that's huge, right?
It's a lot of money to save $215 a month. It'd take you about, I think, 27 years monthly to make that up. So almost the entire length of the mortgage. But to take it one step further, let's look at the person who bought now and refinanced. So in this scenario, your loan amount is lower by $48,000. You're saving $272 a month compared to the person who waited to buy. So you have, at the end of the day, more $48,000 more equity, and you're saving $272 a month. So the idea of buying now and then taking advantage of lower rates when they drop helps you on both the monthly payment and your equity position and how much your net worth is. So at the end of the
a lot of this is predicated upon the assumption too that the market will continue to be robust in Austin. And quite honestly, I don't hear anybody that doesn't think Texas and Austin's financial and economic picture for the long term is anything but rosy.
Absolutely. And I mean, let's assume that this takes 2 years. That means your home value goes up 5% a year, which is a very reasonable and historically accurate appreciation number.
Absolutely. And one thing that we didn't talk about in this example too was, what if we can negotiate the seller to buy down your rate in the first example? Well, then you're even more ahead of the game to begin with.
Absolutely. Yeah.
All right. So sum it up for me.
So at the end of the day, the person who bought now, refinance later, compared to the person who just waited to buy, on this $500,000 house, which is now worth $550,000, they're saving $272 a month, and they have $48,000 more equity. So they received a 50% ROI, their return on investment, because their down payment was $100,000 and they made $50,000 in appreciation. So that's a 50% ROI, where that other person was either renting and not making anything on that, on any investment of any kind. So it's the same concept. I cannot count how many people I've spoken with who have the exact same sentiment. I'm going to wait to buy when rates go down. Well, so is everyone else. So all you're doing is setting yourself up to have more competition and buy at a higher price point for the house you could get a discount on today.
And, you know, this has played out in history too. I've heard Gary Keller talk about 18% interest rates in the early 80s, late 70s. But what he said was 10 years later, the people that went ahead and bought, they'd had a chance to refi and they'd locked in their acquisition cost way below where it was in the late 80s. So they had the last laugh as interest rates, because they'd refied at some point along, and then now their house is worth twice what it was. So
exactly.
thanks, Nick. I appreciate you summing it up for us.
You're welcome. Thanks for having me.